Figuring out the best place to invest your money is no easy task. Are you better off going with high growth, high risk companies like Tesla that can go up 700% in 1 year but come crashing down 60% in the same space of time? What about diversified ETFs like VOO that give you a very consistent but slow return of 10%, but overall definitely don't give you the massive profits that a growth stock might have? Throughout this video, I'll be comparing stocks and ETFs so that you can make an informed decision on which one is the best for you and is ultimately going to make you the most money. Jumping into individual stocks, which is most definitely the most exciting out of the two. These are normally categorized by their market cap or total size of the company. You get the market cap by multiplying the share price by the current number of shares. If you search any major company on Google, it will have the market cap pre-calculated for you. Now this is important because the size of the company will dictate how volatile it is. If a company is only worth a few $1 billion in comparison to $1 trillion, it's going to take far less money to drive the price of it up or down. As a practical example, you can look at the price movements of the company NIO, which had gone up 2,000% from 2020 to 2021. However, in the bear market that we're currently in, where there's not a lot of money available, you can see that this trend happened in reverse and it's come crashing down significantly. At this point in time, its share price has come down 60% and its current market cap is 38 billion. If you compare the price movements of NIO to Apple, which is one of the largest companies in the world with a market cap just over $2 trillion. In the same space of time from 2020 to 2021, Apple's share price had gone up 70%. And now with the current financial situation where the majority of companies are losing value, Apple has only gone down 20% in comparison to NIO's 60%. So you can see as a practical example how the market cap of a company can influence the price movements of a business. If you put your money into a high growth company like NIO, which is just borrowing a lot of money and the current value of the business is based on the future perceived value that the company will have as opposed to how much money it's currently earning. Using a metric like the PE ratio, which is a common figure that investors use to determine if a company is overvalued or undervalued, can go out the window with growth stocks. Something like Tesla, which has a P ratio of 94 in comparison to the S&P 500 average, which is considered to be an accurate reflection of the overall stock market, has a P ratio of 21. So something like Tesla has a P ratio 4 times the average of the stock market norm. However, this doesn't stop people from investing into it, and this can be reflected from the stock price movements of the company. With an individual business, you're taking more risk because all of your money is riding on one company. And if you're investing in a growth stock, this can be quite a roller coaster in terms of how the share price movements change from year to year. If you want a safer option when it comes to individual stocks, then there's also blue chip companies which are well-established leaders in a specific sector. Think companies like Coca-Cola, Microsoft and Apple. These businesses have been around for decades and they are amongst the largest companies in the world. While they are individual stocks, their market cap is typically in the trillions, and as you saw from Apple, it's quite hard to actually have a significant drop with these types of companies. If you're someone that wants a bit more security, blue chip investments are a great place to actually put your money. If you're someone that's happy with a bit more volatility, then growth stocks might be more suited to you. However, when you're picking an individual company, then you also have to do research on that business. If you're blindly following people's advice that you might see on YouTube videos or Instagram posts, it's quite easy to get burned because normally these predictions can appear to be accurate, but it's normally when there's a bull run happening. And this is just when the vast majority of companies in the stock market are gaining value and seeing increases in their share price. Once you come into a bear market like the one we have now, then these predictions don't seem so accurate anymore, and then only the companies with true value will be able to hold their stock price without massive drops. So doing your own research when it comes to picking individual businesses is critical to make sure that you don't lose out and see a massive drop in the value of your portfolio. In comparison to ETFs, which are exchange traded funds, and these are essentially just a collection of stocks that are based on a particular goal. There are ETFs which track the 100 largest companies in the world, ones that look at specific sectors of the market like technology or new and innovative companies such as those offered by the ARK Innovation ETF. And there's also ETFs that track the overall performance of a country's stock market. In New Zealand, there's the NZX Top 50, in Australia, the ASX 200, and then also in America, most notably, the S&P 500. This is considered to be the gold standard of investing, and when you buy into this, you're getting a small piece of the overall stock market. ETFs are a great way to get diversified access to the overall stock market in a cheap way. If you consider all the brokerage fees you'd have to pay to get the same number of companies in the S&P 500, you would have to have 500 individual transactions to buy all of these businesses. In comparison to making one investment of say $1,000 into the S&P 500, that $1,000 would be spread out amongst all 500 companies in that ETF. It also means you get a nice consistent return of 10%, which has been the average return for the past 100 years of this investment. It's much more of a hands-free approach or passive investing because you don't have to do any research on the companies. You're always going to have targeted exposure to the biggest companies in the world, and quite often there's also a dividend payout, so you can get a bit more passive income from the strategy. Having a balanced portfolio of ETFs and individual stocks is really a great way to capture all the ups and downs of the stock market itself. Potentially based on how much risk you're willing to take, you might vary the ratio, but about 50-50 between stocks and ETFs is always a very safe strategy. Now that you know the difference between stocks and ETFs, how do you actually go about buying these? Check out this video on screen to see a complete step-by-step guide of how to actually invest in the New Zealand stock market, from picking the right broker, getting the money available to invest, and then finally a step-by-step tutorial on how to actually purchase shares of some of these investments.